Thank you to Trade Ideas. Thank you to all of you and all of you in on the live stream. Is this a wonderful setting or what? You look around, yeah, inspiring. But our challenge is not just to have an inspiring view. Our challenge is to make sure we come away from this event with inspiration and more specifically with ideas. You're here for a reason. You're here to learn. Not just learn some abstract facts. You're here to learn something that will help take you to the next level in your trading. So I want to challenge each of you to challenge us, the speakers. Come up with questions. Figure out in your head, what do I want to take away from this event? We're going to have a panel session this afternoon, and you're going to be able to ask your questions of the folks on that panel, including myself. What a great opportunity to come away with inspiration, to come away with ideas, and as we start a new year, to come away with something that will make you better as a person and as a trader. Okay, so just a couple of preliminaries before launching into our topic of boosting your cognitive development. What do you guys think of the markets lately? Fun. I noticed there's some volatility. Did anyone else notice that? Yeah. Well, you know, it's volatility is opportunity, and volatility can be risk and threat, right? And here we are coming toward the end of the year. How do hedge fund managers, the people I work with, how do they get paid? When do they get paid? End of the year. Now, how would you feel if your portfolio is moving like this going into the date at which you're going to get paid? So a lot of people pulling back from risk here at the same time that this could create, for nimble traders, some opportunity. So we had an interesting situation lately where if you look at every S&P 500 stock and you look at whether it's trading above or below its various moving averages, 3-day moving average, 5-day moving average, 10-day, 20-day. We had a situation recently where fewer than 10% of all the stocks in the S&P 500 universe were trading above these short-term moving averages. So everything's getting sold, pretty much. And if you look at the 50-day moving average, the 100-day moving average, 200-day moving average, can you believe I keep track of all this shit? If you look at the 50, the 100, the 200, then less than half of the stocks. Even though we've been in an uptrend, less than half of the stocks trading above those moving averages. So I went back to 2006 to my trusty database, over 3,000 days of data, and this has happened 29 times. Now, 29 is a fraction of 3,000. I think that's somewhere in the range of 1%. I'm a real quant, okay? So this is a relatively rare event. And what tends to happen, at least if we look at historical norms, what has tended to happen after such a broad sell-off? Out of 29 events, if you look 50 days later, which would put us toward year end, right? If you look 50 days later, the S&P 500 was up 22 times, down 7, for an average gain of over 5% in the index. 22 up, 7 down. And 5 of those 7 occurrences that were down all occurred during 2008. You remember 2008? Some of you were born then. Come on, fess up. Yeah, so big bear market of 2008. So going forward, thinking about this in an open-minded psychological way. We want to be open to the possibility that this is a severe correction, but that going into year end, we could have one heck of a rally. But we also want to play in our heads, could this be a replay of 2008? Could this be a replay of 1972 to 1974? Now I'm talking about the markets I remember. Is this a start of a big bear market, or is this something corrective? What would we have to do to think through, to distinguish between those scenarios? That could make or break the rest of the year for us. So what you want with these kind of historical statistics is open-mindedness. The managers I work with, they play different scenarios in their head. And what would I need to see to support scenario A? What would I need to see to tell me that scenario B is happening? And that helps them place their bets in a thoughtful way. But when the market went down, on a number of occasions it was down by double digits. When the market went up, on a number of occasions it was up double digits. Volatility tends to beget further volatility. And so we could be looking at good opportunity between now and end of year. Okay. So in the work I've done in trading psychology, if there's one overarching theme, it's that I've looked to broaden the application of psychology to trading and investment. If you read different books and articles on trading psychology, what do they all talk about? They talk about how we have to be emotionally controlled and we have to be disciplined. Or on the other hand, we have to listen to our feelings. We have to be whatever. It's like, I work with asset management firms. I work with hedge funds. People are not dealing with that, okay? I mean, it doesn't mean it's irrelevant, but it's such a fraction of what psychology has to bring to the trading world. So, what are some broader applications of psychology? That's some of what we're going to be talking about today. And that's why, as a topic, I chose boosting your cognitive development. So we're not looking at personality, which is what everyone likes to look at. We're looking at how you process information and how can you become a better information processor. 3 different funds that I've worked at, we have done internal research about what makes traders successful. Detailed research. One of the projects involved a national research organization. And a major takeaway was that the successful traders are distinguished not so much by their personality traits, but by their cognitive strengths, by their strengths in processing information. So let's take a look at that. Before we do, there's my blog site, traderfeed.blogspot.com. Just this morning, I posted something on physical well-being, exercise, physical wellness, how that affects our information processing, how that affects our performance. And Steenbab, Steenbab at AOL.com. If you have questions after this event, please feel free to email me. Okay, so why are we looking at cognitive development? Trading, whether it's the shortest term scalping or swing trading, trading is all about pattern recognition. Now, there are different ways we can think of patterns. We can use technical analysis as a way of thinking about patterns. We can look statistically at patterns. We can construe patterns in many ways, but it's all about reading patterns. Some of those patterns could be with fundamental data. Some could be with the order book and what's bid and offered. What we see among successful traders is strengths in at least one of 2 domains. The successful traders, either they are very good as fast thinkers, or they are very good as deep thinkers. So, excuse me, some of you may be familiar with Daniel Kahneman's book, Thinking Fast and Slow. That's really what we're talking about here. Fast thinking is seeing patterns in real time and reacting quickly. Stuff is going on around us, and we see a car pull in front of us, and then a pedestrian's coming in, and quickly we adjust our car so we don't hit the other vehicle, we don't hit the pedestrian. That's fast thinking. Slow, deep thinking is much more analytical. We're taking a look at a situation, we're looking at it from multiple sides, we're processing lots of different information and coming to some conclusion. The more we are looking at short-term trading and scalping, the more we're looking, obviously, at fast thinking. The more we're looking at investing, researching companies, researching macroeconomic data, that's obviously the slower, deeper thinking. Now, some people do have strengths, both as fast thinkers and as deep thinkers, but typically we have distinctive strengths in one domain or the other. And a major way that we can fuck up our trading, am I allowed to say that? We can fuck up our trading. It's part of my psychology background. They taught us that. They taught us that in PhD school. A major way that we can mess up our trading is by getting away from our cognitive strengths, and suddenly the fast thinker turns into a slow, deep thinker. How many of you have heard of analysis? Paralysis by analysis. That's what's happening. And what happens when the slower, deeper thinker starts to get concerned about their position and they start watching every tick on the screen? What happens? They overtrade. They make poor decisions. So a big part of success in terms of trading psychology is knowing our cognitive strengths and adapting our trading to what we are good at as information processors. Now, what are some of those cognitive strengths? One of those is degree of focus. How well can we sustain concentration over time? In studying the successful traders, we found they have unusually strong focus. They're like the laser beam, and they can continue minute after minute, hour after hour, they can continue processing information intensively, whereas others become much more easily cognitively fatigued. So depth of focus is important, but also breadth of focus. Breadth of focus because much of the pattern recognition is looking at different things and how they are related to each other. So for instance, we could get, and I can relate this from my own trading, you get the S&P coming up and it's going up, it's going down, going up, going down after having rallied. And then you notice a couple of sectors within the S&P universe starting to tail off. And then you also notice that volatility is starting to increase on a short-term basis. And you're putting all these things together and you're recognizing, aha, it looks like the market's topping. You come up with an idea and you sell the market. So you're looking in a focused way, but broadly to relate different pieces of information. Yet another dimension cognitively is not only our degree of focus and the breadth of our focus, but the degree to which we can achieve in here internal quiet. Successful trading requires a quiet mind. It's one of the reasons we're seeing meditation become so popular among professional traders. Now, why would a quiet mind do well? If our mind's not quiet, we're chattering to ourselves about what the market's doing or not doing. Oh, these algos, they're doing it again. Yeah. We all been there. What does that interfere with? What's the problem there? Much of pattern recognition occurs outside of explicit conscious reasoning. We can detect patterns without necessarily being able to verbalize what we're detecting. We can talk to another human being, and we can hear in their tone, we can see in their face, their reactions, and we can infer what their state of mind is. We can infer whether they like us or don't like us. That's pattern recognition. But if we fill our heads with our own thoughts and our own worries and our own greedy desires, then we lose access to that intuition. We lose access to that pattern recognition. This is a very important concept. And in fact, I'll make an announcement here. I haven't announced it yet formally. My next book is going to be, is going to be about trading and spirituality. Now, trading? What? Trading's all about making money. What's spiritual about that? But in fact, if you look at all the problems in trading psychology, almost all of them are a result of the ego getting in the way. When we quiet our minds, we are quieting the ego. The part that's looking at P&L, the part that wants to make lots of money, the part that doesn't want to lose money, the part that wants to be a big man and talk online about all the things that he's done well. We want to quiet that. And in quieting the ego, we gain access to pattern recognition on a much broader level. So interestingly, by developing ourselves as spiritual beings, I believe we can achieve our greatest material success. Okay, some characteristics of successful traders. Conscientiousness, that's a personality trait, one of the top 5 personality traits in the psychology research. Conscientious person is detail-oriented, does things by the book. Emotional stability, someone who doesn't have wild ups and downs. What we found with our research is that having one of those two was necessary. Thank you. For success. If you don't have conscientiousness, which is sort of like discipline, and you don't have emotional stability, what happens? You trade reactively. You can't do that fast or slow thinking in a powerful way. Openness to experience is a third dimension. Openness to experience is related to intellectual curiosity. In fact, intellectual curiosity was one of the best predictors of trading success in our research. Now, why would that be? Well, someone who's intellectually curious. Because they're always looking into markets, always researching, always coming up with new ideas, and that allows them to adapt to changing market conditions. We talked about having a distinctive information processing style. Some managers I work with process information best by reading research. Research on the sell side, they'll look at reports on macroeconomic data, and there are others who process information best actively and interactively, talking it out loud, hearing themselves, hearing other people. That's a totally different information processing style. much of the challenge that traders face is that they are not utilizing their best information processing styles and strengths. Maybe they process information interpersonally and actively, but how are they trading? They're sitting at home, screens in front of them, and they're relatively isolated. Creativity and breadth of processing. Show me a successful trader, I will show you someone who is approaching markets with a degree of uniqueness. That's where creativity comes in. Creativity is related to the openness and the intellectual curiosity. Creativity means looking at old data in new ways and looking at new data that other people aren't looking at. It turns out that people who are looking at the same information in the same way, they place the same trades as everyone else. And being part of the herd, they're not successful. So not only what are you doing well, what are you doing uniquely? That's what creativity is all about. And finally, a process orientation. In my most recent book, The Trading Psychology 2.0, I talk about taking best practices, what we do best, and turning them into best processes, something that we can repeat day in, day out, day in, day out. In addition to working with traders, I teach at a medical school in Syracuse, New York. And the medical professionals, like the surgeons, they study their outcomes. They look at what works and what doesn't work in surgery, what has more complications, less complications. And they keep track of that. And they constantly change their process to adapt to the outcomes that they're observing. So they're constantly getting better, constantly getting better. And those processes are in checklists. You may be familiar with Atul Gawande's book, The Checklist Manifesto. The traders I work with create checklists that ground them in their best practices and turn those into best processes. Two ways that we can increase our information processing and increase our bandwidth. A huge challenge for us cognitively as traders is to be able to process as much information effectively as possible. And there are two big ways of doing that. One is by building a team, and we see this happening in hedge funds all around. Individual portfolio managers are hiring analysts, hiring team members to help them keep track of different markets and strategies. And hybrid trading, which is the integration of discretionary trading with more quantitative, model-based trading. Both are ways in which we can look at more markets, more opportunities in different ways. I notice here in the audience is my good colleague, Mike Bellafiore. And one of the things that he's been working on, that we've been working on at his firm, SMB, is creating teams and conducting mentoring within teams so that people are learning from senior traders, but also generating ideas for those senior traders. At hedge funds, we see hybrid teams where discretionary portfolio managers are hiring quants, young quants, who become part of the team to generate new and different ideas.
On that last slide, two of the boxes were repeated.
Yes, there was a problem with the, yes, I apologize for that. What are some reasons that traders fail? One I alluded to earlier, correlation. Everyone looking at the same information, doing the same things. They become part of the herd. The inability to adapt to changing market conditions. All of a sudden, we were in a bull market and volatility increases, correlations among different sectors of the market increase, direction changes, we have to adapt our trading and risk-taking. And lack of strategy diversification. One great way of identifying a failing trader, or a trader about to fail, is asking them how they trade, what they do, and you find out that they're basically always bullish, or they're basically always bearish, or they're basically always trading the trend. Well, markets aren't always trending, markets aren't always bullish, and markets aren't always bearish, and so that lack of diversification in strategy ends up creating very uneven returns. And so what we see among successful traders is the ability to make money in different ways, to make money in different market conditions. And that's where the team building and the hybrid trading can be very helpful. Oh. Okay. Hybrid teams. Hybrid teams are all about using technology to make us better cognitively, to increase our bandwidth. So it's no accident that we're talking about this at the Trade Ideas event, where a lot of the discussion is about artificial intelligence. Using technology for filtering the market and finding good stocks to trade, as Mike calls them, stocks in play. Using technology to automate trading. What if you see 10 or 15 great opportunities? The technology can place a basket of trades for you and capture all those opportunities. You would never be able to be on top of that just on your own. Using technology for idea generation. Isn't that what Trade Ideas does, right? You're looking to the technology to give you some ideas that then you can look into in your own discretionary ways. So the technology, think about this, you are a team. When you adapt yourself and adopt technology, you're creating a team. It's you, the trader, and your teammate is the technology. And that expands you. And that's what I mean by using technology for teamwork. Using technology to track your trading. One of the things that I found consistently where I've worked is that the people who are successful track their trading. They track how many winning trades they have, how many losing trades they have, how many winning days, losing days, and they use the data, they use the results, just like the physicians I talked about. They use that information to learn what they've done well, so they can do more of it, and to identify what they could be doing better. The data that you track in your trading helps you figure out what you're doing right and wrong. And finally, using technology for model building. So we can generate models that help us identify unique opportunities in markets by monitoring what has happened in history and how that relates to what is setting up now. So I'm going to say something some of you may agree with, some of you may not agree with. I think we are entering a really unique time in quantitative finance with the advent of what's called machine learning. There's a lot of misunderstanding about what machine learning is. I work with teams that employ machine learning. There is a book that recently came on the market called Advances in Machine Learning. And the book is by the most prominent money manager in the world who is utilizing these techniques. His name is Marcos Lopez de Prado. And I encourage you to look at his website. There's a lot of math there. But there are firms using this money to manage billions of dollars very, very successfully. And the way they are doing that is by not only creating technology that creates models of markets, but that engages in ongoing continuous modeling. So imagine coming up with a historical analysis, sort of like what I did with the situation of the sell-off, but that historical analysis keeps updating by itself and keeps spitting out odds to you continuously. So the machine is learning patterns that are evolving in the market. That ability to learn in an evolving way helps us keep on top of opportunities that may not have existed just a day or two or a month or two ago. Some of the machine learning firms that I know of and have worked with not only employ models that have predictive value, but what I call meta models. So the meta model, imagine a firm that has 20 different models. And the meta model tells you what kind of market we're in, what kind of regime we are in. Are we in a regime of higher correlation, lower correlation, higher volatility, lower volatility? And as the regimes change, as the market environment changes, it turns off certain models and sizes up other ones, continually adapting. Think about how that expands a trader's bandwidth to be able to adapt in those kind of ways. Ensemble modeling is one such technique that avoids overfitting of data. We can look at big relationships with lots and lots of data, and we can find random relationships in those data. There are statistical techniques, ensemble modeling is one of them, that helps us minimize the odds of overfitting. And the book I mentioned talks quite a bit about that. Turns out the majority of quant firms, by the way, are losing money. That's not well appreciated. There's a direct correlation between the mathematical sophistication of the firm and its degree of success. The ones who are not using more advanced mathematical methods are actually not doing well. And you can actually trade against them. Okay. So when we have technology that can provide us with background as traders, the discretionary and the quant, the complementarity, it helps everyone improve. So what's happening is that the discretionary trader comes up with ideas that can become new models. The machine is coming up with new learning, new adaptations, new outputs that can feed the trader. So the trader's experience can help create models. The models can feed the head of the trader. There's a complementarity there. What we also see when there's a hybrid team is that the discretionary trader will come up with an idea, and the machine, independently by itself, will come up with the same idea. That gives you a pretty high confidence trade. And of course, the synergy of being able to trade multiple markets, multiple stocks at one time with the bandwidth that the technology provides. Some of the portfolio managers I work with create dashboards out of their models. They find key variables to look at in the market. They create models for each one of those variables. They create displays for those models. So there's a dashboard telling them, for instance, if one aspect of one variable they're looking at is trending, then their trend measure shows up on their screen. And so they have all these displays updating in real time, telling them, is the market getting more volatile, less volatile, trending more, trending less? And those displays help that pattern recognition for decision support in real time. And the hybrid trading can help our creativity. The models spit out results. You see results from this model, this model, this model, this model, and you say to yourself, if this stock is showing up bullish, and this stock is showing up bullish, and this stock is showing up bullish, what might that mean for the market overall? So you're generating a new hypothesis based on the outputs that you're getting from the machine. That's feeding your creativity. That's helping you think about something new and different that you wouldn't have thought about if you didn't have those inputs. The models can help us with understanding, not just prediction. The models can tell us what is going on beneath the surface, and so that we can actually see, is this a market that's getting stronger? Is this a market that's getting weaker? Some of you who have read my Trader Feed blog know that I look at charts where the bars are denominated in volume. So a new bar prints for every number of thousands of shares traded, or every number of contracts traded. So there's an open, high, low, close for those volume bars. And then we take a look at the volatility of the volume bars. What does that mean? The size of the volume bars. Why would that be interesting? Why would that be helpful? Normally, we look at bars based on time, and so when more volume comes into a stock or more volume comes into a market, it's going to be a bigger bar. It's going to move more, on average. But if you look at a volume bar, and the volume bars start getting bigger, what does that tell you? Think.
Trend change.
What's that?
Trend change.
It could be a trend change. It certainly could be evidence of momentum. The same amount of volume is moving the market more. What is the amount of movement per unit of volume? People don't even think about that. They don't look at that. You can create models that'll tell you that this thing's coming out of a bottom, and now suddenly the same amount of volume is moving the market more on the upside. What great information that helps us understand what's going on in the market, not just try to predict what will happen in the future. Okay, lots of challenges, obviously, as individual traders to our implementing hybrid trading: lack of resources to invest, a lack of math and programming talent, challenges that we have, a lack of resources in hiring new talent, learning new software, creating new processes, and ego. You know, we want to do things ourselves. We don't want to necessarily admit that we need additional resources. But, as individual traders, and this is really the main takeaway from my talk, there are many creative things that you can do to become hybrid. There are trading firms that are doing amazing things with technology and that are hiring and that allow you in a team structure to make creative use of technology. There are resources for home growing models and developing your own predictive models. There's a platform called Adapt Trade that's helpful in that regard. We can use platforms that have user-friendly interfaces, where the technology is in the background. We give it the questions, and the technology comes up with the answers. Trade Ideas comes to mind there. So there are many ways that you as an individual trader can create a virtual team. Imagine doing this with other traders that you link up with. By working in teams at a firm, by using technology that's right for you, and then connecting with other users, you can build a team. You can build your bandwidth. And that is just as important in trading psychology as anything you'll do with your emotions. It gives us camaraderie, a sense of teamwork. It feeds our intellectual curiosity, our sense of mastery. It can help us trade more opportunities and achieve smoother returns, build our business as traders. And it can help us improve our processes, how we do what we do. The reasons traders fail are the same as the reasons many businesses, startup businesses fail. They're not well enough capitalized. They're doing the same thing as their competitors. They're not adapting to their marketplace and providing the right opportunities for consumers. That's how businesses fail. That's how traders fail. We have an opportunity to utilize emerging technology to create our own teams, to expand our bandwidth, to become much, much more effective in what we do. And in doing so, we increase our sense of mastery and improve our trading psychology. Danke! I look forward to questions. Thank you.